A large but mostly unrecognized risk has been quietly building within the global financial system, growing steadily while attention remains focused on familiar institutions like banks, stock exchanges, and public debt markets. This threat does not originate from the traditional centers of financial stress that usually dominate headlines during crises, nor does it stem from the areas that regulators and investors routinely monitor. Instead, it has taken shape in a shadowed segment of finance where private lenders have constructed an enormous network of loans now estimated at roughly $1.3 trillion in size. For more than a decade, this market expanded largely out of public view, increasing far more rapidly than most people realized. What began as a small and specialized lending alternative gradually evolved into a powerful force capable of influencing global markets, corporate behavior, and the flow of capital across economies. Since the aftermath of the 2008 financial crisis, private credit has transformed from a niche strategy into a core pillar of modern finance. As banks face tighter regulations, higher capital requirements, and stricter oversight, their willingness to lend declined sharply. Companies that once depended on banks for financing suddenly encountered delays, rejections, or reduced loan sizes. Into this gap stepped private credit firms, offering a different approach to lending that emphasized speed, flexibility, and customization. These lenders promised faster decisions, fewer regulatory hurdles, and tailored loan structures designed to meet the specific needs of borrowers. This shift reshaped how businesses accessed capital, making private credit an attractive option for companies seeking funds for expansion, acquisitions, refinancing, or basic operations. At the same time, the global investment environment was defined by historically low interest rates that persisted for years. Traditional income-generating assets such as government bonds, high-quality corporate debt, and savings instruments delivered minimal returns, leaving investors struggling to meet long-term obligations. Pension funds, insurance companies, endowments, and institutional investors began searching aggressively for higher yields, and private credit appeared to offer an appealing solution. By lending directly to companies at higher interest rates than banks typically charged, private credit funds promised stronger returns while avoiding the volatility of public markets. As investor demand increased, massive amounts of capital flowed into these funds, allowing private lenders to scale rapidly. The size of individual loans expanded dramatically, moving from modest amounts to transactions involving hundreds of millions of dollars, and in some cases exceeding $1 billion. This rapid growth was reinforced by a mutually beneficial cycle in which companies welcomed easier access to capital and investors welcomed higher yields. Unlike traditional loans issued through banks or bonds sold on public markets, private credit transactions are conducted privately, with limited disclosure requirements and minimal transparency. Loan terms are negotiated behind closed doors, and details about borrower risk, leverage, and repayment structures are often unavailable to the public. There are no standardized reporting rules that provide regulators or analysts with a comprehensive view of the market, making it difficult to assess how much risk is accumulating or where vulnerabilities may exist. Even experienced financial professionals often lack access to complete information about these loans, relying instead on partial data or estimates. This opacity has allowed private credit to grow quickly and operate with considerable freedom, but it has also created conditions where potential weaknesses can remain hidden for extended periods. Over time, private credit has developed into a parallel financial system that operates alongside traditional banking, but without comparable oversight or safeguards. While this system has provided vital funding to businesses and supported economic activity during periods of uncertainty, it has also created a vast and interconnected web of obligations that exists largely outside public scrutiny. The primary concern among experts is not simply the existence of private credit, but the speed, scale, and limited visibility of its expansion. As this market continues to grow, it holds the capacity to amplify financial stress if economic conditions shift, raising serious questions about its resilience, and about how prepared the broader financial system may be if pressure begins to emerge within this increasingly influential yet largely hidden corner of global finance. The rapid rise of private credit was not accidental but the result of several powerful forces converging at the same time, reshaping the lending landscape after the global financial crisis. When banks retreated from risk following 2008, they did so under pressure from regulators who demanded stronger balance sheets, higher capital reserves, and strict stress testing to prevent another systemic collapse. These reforms were designed to protect the financial system, but they also made banks far more cautious and selective in their lending. Many businesses that once relied on bank loans suddenly found themselves unable to secure funding or forced to endure long approval processes and tighter conditions. This created a substantial gap in the market where demand for credit remained strong but traditional supply had weakened. Private credit funds moved quickly to fill this space, offering companies an alternative source of capital that bypassed many of the restrictions banks faced. These funds could approve loans faster, negotiate customized terms, and provide large amounts of money with fewer procedural barriers. At the same time, the global economy entered a prolonged period of exceptionally low interest rates. Central banks kept rates near historic lows to support growth, stabilize markets, and encourage borrowing. While this policy helped sustain economic activity, it also reduced returns on traditional investments. Investors who depended on steady income, such as pension funds, insurance companies, and long-term institutional investors, struggled to generate sufficient yields from government bonds, high-grade corporate debt, or savings instruments. In response, they began searching for alternatives that offered higher returns without the volatility of equities. Private credit emerged as an attractive solution, promising yields significantly above those available in traditional fixed-income markets. As capital poured into private credit funds, lenders became increasingly confident and aggressive in expanding their operations. They began financing larger acquisitions, supporting complex buyouts, and working with companies that banks might have rejected outright. Many deals were structured quickly, often with fewer public disclosures and less external scrutiny than comparable bank loans. This environment encouraged rapid expansion, with new lenders entering the market and existing firms raising ever larger funds. The competition for deals intensified, pushing private lenders to offer more flexible terms to win borrowers. One critical difference between private credit and traditional banking lies in regulation. Banks are required to follow standardized risk models, maintain capital buffers, report exposures regularly, and submit to regulatory oversight designed to limit systemic risk. Private credit funds operate under a different framework, facing far fewer regulatory obligations. Their lending decisions are often based on internal assessments and private negotiations rather than standardized rules. This flexibility allows them to move quickly and adapt to borrower needs, but it also removes layers of protection intended to stabilize the financial system. Another factor fueling growth was the ability of private credit to serve borrowers with higher risk profiles. Companies with significant existing debt, lower credit ratings, or exposure to volatile industries often found private lenders more willing to provide financing. This expanded pool of borrowers accelerated market growth, as deals that would have been considered too risky for banks became common within private credit portfolios. As these forces combined, private credit grew from a small, specialized segment into a dominant player capable of rivaling traditional lending channels. The interaction of cautious banks, yield-hungry investors, and flexible private lenders created a powerful engine of expansion. While this system delivered capital efficiently and supported business activity, it also laid the foundation for a market that grew faster than oversight, increasing the complexity and interconnectedness of risk beneath the surface of the global financial system. As private credit continued to expand, the risks embedded within the system grew alongside it, though much of this danger remained largely invisible to the public and even to many market participants. One of the most serious concerns surrounding private credit is the lack of transparency that defines how these loans operate. Unlike banks, which must publish detailed financial statements, disclose loan performance, and report exposures to regulators, private credit firms conduct their activities behind closed doors. Loan terms are negotiated privately, performance data is limited, and there is no centralized system that tracks the full scale of exposure across hundreds of funds and thousands of borrowers. This opacity makes it extremely difficult to assess how much risk is building within the system or whether certain industries are becoming dangerously overleveraged. Regulators face challenges in monitoring the market because the data they receive is fragmented and incomplete, leaving large blind spots in understanding systemic vulnerability. Another major risk stems from the profile of the borrowers themselves. Many companies that rely on private credit do so because they cannot qualify for traditional bank loans or public bond markets. These businesses may already carry heavy debt burdens, operate with thin profit margins, or depend on optimistic growth projections to remain solvent. In periods of economic stability, these weaknesses can be masked by steady cash flows and manageable borrowing costs. However, when economic conditions shift, such as during periods of rising interest rates or slowing demand, these vulnerabilities can quickly become critical. A large portion of private credit loans carry floating interest rates, meaning borrowing costs increase as central banks raise rates. While this benefits lenders on paper, it places significant strain on borrowers whose interest expenses can rise sharply in a short period of time. Companies that borrowed during years of low rates may suddenly find themselves facing much higher monthly obligations without a corresponding increase in revenue. This dynamic increases the probability of defaults, restructurings, or distressed sales. Liquidity risk further complicates the picture. Investors in private credit funds typically cannot withdraw their capital quickly. These funds often impose lockup periods, redemption limits, or delayed withdrawal mechanisms that restrict access to cash. During stable periods, this illiquidity may not appear problematic. However, in times of stress, when investors seek to reduce exposure or raise cash, these restrictions can amplify panic. Funds may be forced to freeze redemptions, slow payouts, or sell loans at discounted prices, potentially triggering losses that spread across portfolios. Leverage adds another layer of risk. Some private credit funds borrow money themselves to increase the size of their lending operations, magnifying returns during favorable conditions, but intensifying losses when borrowers fail. If defaults rise, leveraged funds can quickly face pressure not only from unpaid loans but also from their own debt obligations. In some cases, banks provide financing to these funds, creating a channel through which stress in private credit can flow back into the traditional banking system. Competitive pressure within the private credit market also contributes to rising risk. As more lenders chase deals, some may loosen lending standards, accept weaker protections, or agree to more borrower-friendly terms to secure business. Over time, this can result in a market filled with complex loan agreements that appear stable during growth periods but become fragile when conditions deteriorate. Recent bankruptcies among companies heavily financed by private credit have demonstrated that these risks are not hypothetical. Businesses with high leverage and limited flexibility have already struggled to meet obligations as interest rates rose and revenues slowed. Analysts studying these failures have identified patterns reminiscent of earlier credit cycles, where rapid growth and optimistic assumptions obscured underlying weaknesses. While private credit supporters argue that the market is diversified and professionally managed, critics warn that the combination of opacity, leverage, illiquidity, and aggressive lending could allow stress to build quietly until a shock exposes vulnerabilities across multiple sectors at once. As stress begins to surface within private credit, the way that risk spreads through the financial system becomes a central concern, because this market is deeply interconnected with institutions and investors that extend far beyond the funds making the loans. When private credit borrowers start to struggle, the immediate losses fall on investors who provided capital to these funds, including pension plans, insurance companies, endowments, and asset managers responsible for the savings of millions of people. These losses do not remain isolated events. Reduced returns or write-downs force investors to reassess their exposure, often leading them to slow new commitments, demand tighter terms, or pull back from risk altogether. As confidence weakens, the flow of capital into private credit can decline rapidly, tightening credit conditions for businesses that depend on these loans to refinance debt, fund operations, or support expansion. This tightening can cascade through the economy as companies facing reduced access to funding are forced to cut costs, delay projects, freeze hiring, or in extreme cases shut down entirely. Smaller and mid-sized firms are especially vulnerable because they lack the diversified funding options available to large corporations. As these businesses scale back, suppliers lose orders, workers face layoffs, and consumer spending weakens, spreading the impact beyond the financial sector. Market sentiment can deteriorate quickly in such environments, prompting broader asset sell-offs as investors seek safety. Even firms with no dire exposure to private credit can feel the effects as tighter financial conditions reduce overall economic activity. Another critical issue is the potential for synchronized stress across multiple sectors. Because private credit funds often target similar types of borrowers, including leveraged companies, private equity-backed firms, and businesses with limited access to bank financing, a downturn in one industry can spill into others. If several sectors experience pressure simultaneously, default rates can rise together rather than in isolation, amplifying losses for lenders and investors. The lack of standardized reporting makes it difficult to determine how concentrated these risks truly are, raising the possibility that multiple funds could face problems at the same time without warning. This dynamic mirrors patterns seen in previous credit cycles, where prolonged periods of easy money encouraged borrowing and risk-taking, only for vulnerabilities to emerge once economic conditions shifted. Economists often describe this process as a build-up toward a tipping point, where confidence masks fragility until a trigger exposes weaknesses across the system. In the private credit market, many loans were issued during years of low interest rates and strong growth assumptions. As borrowing costs rise and revenue growth slows, these assumptions are increasingly tested. If enough borrowers fail to meet obligations, the resulting losses can erode trust in the entire market. Funds may respond by tightening lending standards abruptly, which can worsen economic conditions by reducing the availability of credit just when it is most needed. The interconnected nature of modern finance increases the risk that stress in private credit could spread beyond its boundaries. Banks that provide financing to private credit funds, institutions that invest heavily in them, and markets that rely on steady capital flows are all linked through complex financial relationships. A disruption in one area can transmit pressure across others, creating feedback loops that intensify instability. While private credit proponents argue that the market is resilient and diversified, critics emphasize that resilience is difficult to measure in a system where data is limited and transparency is low. The concern is not that every loan will fail, but that the structure of the market allows risk to accumulate quietly until it reaches a level that becomes difficult to control. Regulatory attention toward private credit has increased as concerns grow about the size and opacity of the market, yet meaningful oversight remains limited compared to traditional banking. Financial authorities have acknowledged that large volumes of lending now occur outside the regulated system, making it harder to assess systemic risk or respond quickly if conditions deteriorate. Unlike banks, private credit funds are not required to undergo standardized stress tests or disclose detailed loan-level data, which limits regulators' ability to evaluate how these portfolios might perform during a severe downturn. This gap creates uncertainty about where vulnerabilities are concentrated and how quickly losses could spread. Some regulators have issued warnings, noting that rapid growth combined with leverage and illiquidity can amplify shocks, but concrete policy responses have been slow and fragmented. One reason is the complexity of the market itself, which includes hundreds of funds, diverse strategies, and private contractual structures that resist uniform rules. Another factor is the role private credit now plays in supporting business activity, making aggressive regulation politically and economically sensitive. Supporters argue that excessive oversight could choke off funding to companies that depend on these loans, potentially slowing growth and reducing competitiveness. Critics counter that the absence of clear rules encourages risk-taking and allows problems to build unseen. They point out that transparency is not about stopping lending, but about understanding where stress could emerge before it becomes unmanageable. The challenge is that private credit sits between two worlds, large enough to influence the broader economy, yet structured in a way that keeps it largely outside public scrutiny. As economic conditions remain uncertain, regulators, investors, and institutions are watching closely for signals such as rising default rates, tighter refinancing conditions, and shifts in investor behavior. These indicators offer clues about whether the market can absorb pressure or whether weaknesses are deepening beneath the surface. The debate continues over how to balance innovation and flexibility with stability and oversight, but the underlying issue remains unresolved. A financial system where trillions of dollars move with limited visibility creates risks that are difficult to measure and even harder to contain once stress appears. The private credit market has grown into a central yet largely unseen force within the global financial system, shaping the flow of capital, influencing corporate survival, and affecting economic stability in ways that remain difficult for the public to observe or fully understand. What began as a narrow alternative to bank lending has evolved into a massive structure that now supports thousands of companies across multiple industries and regions, tying together investors, borrowers, and financial institutions through complex and often opaque relationships. This growth has delivered clear benefits, including faster access to funding, customized loan structures, and higher returns for investors, but it has also introduced vulnerabilities that are not easily measured or monitored. Because private credit operates largely outside traditional regulatory frameworks, there is limited visibility into how much risk is concentrated within specific sectors, how leveraged certain funds have become, or how interconnected different lenders and borrowers truly are. During periods of economic stability, these weaknesses remain hidden, masked by steady cash flows and rising valuations. However, when conditions shift, such as during periods of higher interest rates, slowing growth, or reduced access to refinancing, the pressure on heavily indebted companies intensifies rapidly. Borrowers that once managed their obligations comfortably may suddenly struggle as payment costs rise and revenue expectations fall short. When these stresses accumulate across multiple firms at the same time, the impact does not remain confined to individual balance sheets. Losses move outward, first affecting private credit funds, then the investors who provide their capital, including pension funds, insurance companies, and institutions responsible for long-term savings. As confidence weakens, investors may reduce new commitments, slow reinvestment, or seek to exit positions, tightening liquidity across the market. This contraction can limit the availability of credit precisely when businesses need it most, amplifying economic slowdowns and increasing the likelihood of further defaults. The interconnected design of modern finance means that private credit does not exist in isolation. Banks may be indirectly exposed through financing arrangements, markets may react to rising uncertainty, and broader economic activity can be affected as companies reduce hiring, delay expansion, or cut spending. While private credit is not inherently unstable and many loans will continue to perform as expected, the sheer size of the market means that even a modest increase in stress can carry disproportionate consequences. The challenge lies in the fact that much of this risk builds quietly outside public view, without the standardized disclosures or stress testing mechanisms that exist in the traditional banking system. As a result, warning signs may emerge slowly and unevenly, making it difficult to distinguish between isolated problems and systemic pressure. Observers therefore focus on indicators such as rising default rates, strained refinancing conditions, increased use of leverage, and shifts in investor behavior to assess whether underlying stability is weakening. The debate surrounding private credit is not about whether it serves a purpose, but about whether its rapid expansion has outpaced the structures needed to manage its risks effectively. In a financial environment where large amounts of capital move quickly and quietly, understanding where vulnerabilities lie becomes essential. The private credit market now holds enough influence that its behavior can shape outcomes well beyond its immediate participants, affecting employment, investment confidence, and economic resilience. As conditions evolve, the central concern remains whether this powerful yet opaque system can absorb stress without transmitting shocks across the broader economy, or whether unseen weaknesses will surface in ways that challenge the stability built during years of rapid growth.